Hey, it's Tom here and welcome back to the channel. So a couple of days ago I put up a community post here on YouTube asking for your questions for a Q&A video, and this is going to be that Q&A video answering your questions. So thank you to everyone who asked a question. If you do want to get your question featured in a future video, just keep an eye out for my community posts. I always put up a post there a couple of days before filming a Q&A video for the channel. So if you turn all your notifications on for the channel, you should be notified every time I put up one of those posts, and then you can get your question included in the next video. So with all that said, before we get into today's video, we do have a sponsor, and today's sponsor is Hatch. Now, Hatch have been a long-time sponsor of the channel at this point, and they are my personal broker of choice for me as a New Zealander buying shares in large US companies. Now, I initially switched across to Hatch basically solely because of fees. I was paying $90 a trade at one of the big banks for trades I can now do for $3 in Hatch. So significant money saver in terms of fees. They're also continuing to improve the platform throughout the 2 years or so that I've now been a customer of Hatch. And one of their newest additions to the platform is kids accounts. So we all know that compounding works really, really well the earlier you can get started with investing. So if you want to get compounding working really early on your side for your kids, you can now set up those kids accounts and buy shares for even lower fees than you can in a traditional Hatch account. So if you're interested in checking out Hatch, you'll need to go to the link hatch.as/investingwithtom. If you head to that link, sign up and create a new Hatch account and deposit 100 New Zealand dollars into that account, you'll get a free $20 top up so that you can get started investing with a little bit more money. Okay, so first question is from Carol. Hi Tom from sunny Wellington. You've mentioned in previous videos that you keep some US dollars and Australian dollars on hand so you can act quickly when opportunities arise, but you can also buy international stocks through Hatch. Could you share how you manage this in practical terms? Do you have NZ bank accounts in these currencies or overseas accounts? Are there any tax implications, and do you use different brokers, and why do you choose to buy with what currency or broker on a particular occasion? Cheers. Yeah, so you're right, you can just leave US dollars in Hatch, and that's basically all I do. So I obviously have all my everyday accounts in New Zealand dollars. I get paid in New Zealand dollars, have New Zealand dollar savings accounts and so on, but I do leave like a base level of cash just sitting in my Hatch account so that should any opportunities arise in the US, I can buy shares fairly quickly. And I use ASB securities for all of my New Zealand and Australian investing. So I just leave a base level of cash again in an Australian currency call account, I think it's called. And I also have a New Zealand account which I can actually transfer money to quite quickly if I need to, so I don't leave a lot of money in New Zealand dollars with ASB. My everyday banking is Westpac. So there's a few different accounts kind of spread around there, but that's kind of how I manage that in practical terms. Next up, we've got a couple of questions from Diego. What are the 13Fs you look forward to reading the most on filing days? Could you mention some outside of data Roma? And secondly, do you have an investment checklist? If yes, could you do a video on it? So yeah, in terms of 13Fs, basically all the ones that I include in my 13F videos are kind of the main ones I look at. So obviously Warren Buffett, but also Moshe Barai, Guy Spear, Lee Lu, Daily Journal Corporation are all the main ones I look at. There are a few others that I also look at, which I don't include in every video. So people like Cliff Sosin, also Bellpost Group or Seth Klarman. I look a little bit at Michael Burry, but not a huge amount. But really those are the main ones. Maybe Bill Miller as well. I think Miller Value Partners is the fund name there. So those are a few. And on the investment checklist one, that's actually something I've been thinking about this week. I think about it every now and again, and I've never actually sat down and spent the time to actually put together an investing checklist, but I definitely should. So I'm actually going to sit down tonight. I'm going to use this question as a prompt for me to get into gear and actually do that. So right now I don't, but I will put that together. And I know Monish Babrai has talked about investment checklists a bit as well. He kind of views investment checklists as something that are quite personal or specific to that individual investor and specific to him. So he doesn't actually see a lot of value in sharing his own checklist with other people. Not because there's anything secret on it, but because different investors tend to get caught up in making different types of mistakes. So your checklist kind of has to match your investment personality and so on. But yeah, maybe I'll sit down tonight and start working on one of those. So Next question is from R01, I guess. Is that meant to be ROI? I'm not quite sure. Do you use services like Stockopedia or Guru Focus? Would you consider a bit of a review, free 2-week trial below if it's of any use? Yeah, appreciate the link. I don't really. I read a bit of stuff that comes up on various forums and places online. So occasionally I'll get thrown to articles on Guru Focus, but I really don't use either of those two sites kind of religiously. Some sites I do use would be things like Value Investors Club and Corner of Berkshire and Fairfax. Those are both really, really good. And those are kind of sites that I use a little bit as well. So I've mentioned that in previous videos. I think I do have a video on the channel kind of going through some online tools that I use. So feel free to go and check that one out if you like. And next question is from the Adventurous Investor. How's the house hunting going, mate? I imagine it would be tough trying to find anything selling below rateable value at the moment. Yeah, not too many big updates on the buying the first home kind of front. Still working on that one. The big decision I'm trying to make at the moment is basically how we kind of would structure any debt that we get. So I watch a lot of like US investment channels, for example, where they have access to these 30-year fixed rate mortgages, which would just be phenomenal if we had that in New Zealand, but we don't. So it's kind of trying to figure out, like, do we fix for 3 years or 5 years? Or my KiwiSaver provider actually offers like a 30-year floating rate mortgage, which is at a much cheaper rate than many of the banks as well. So that's kind of the main thing we're trying to figure out at the moment, but no major updates in that department. Next question is from Paula Strange. Hi, I'm from Ireland and want to invest in some Australian stocks. I haven't researched any with the exception of Team. Can you point me in the right direction with some suggestions for ideas? Yeah. I haven't done a lot of investing in Australia either, to be honest. I know there are a few different kind of blog sites and things like that where you can learn about investment ideas in Australia and view different write-ups. But yeah, I don't provide stock tips or anything like that on the channel, so I can't help you really with that kind of stuff. But largely I analyze those businesses in the exact same way I would any other company. So I try to understand the business. So is it in my circle of competence? What's the business actually do? Do they have any sort of moat or competitive advantage? What's the management team like? How are they performing? And what's the valuation sort of structured like? So that's kind of how I look at it. And I don't really have any particular preference for certain countries. Like, I'm not someone that kind of starts from the top, level and says I want to have exposure to Australia or New Zealand or the US in certain percentages or anything. I could be 100% invested in New Zealand or 100% invested in the US or 100% invested in South Korea or any place really, as long as the opportunity set is sort of appropriate and it's more attractive than all of the other alternative options that I have. So that's kind of how I think about it. Okay, next question is from Gabriel. What is your opinion about investing in private equities? Examples are companies that they have share selling but not in the open stock market. Yeah, this is actually a question we covered on a live stream that I did just yesterday on Punch Card Investing. So shameless plug and shout out to the Punch Card Investing channel. That's a joint channel with myself and 4 other YouTubers where we do weekly live streams. So head over and follow us there if you don't already. We're trying to tick over that first 1,000 subscribers, so would appreciate any support there. But if you go towards the end of yesterday's live stream where we talked about high quality managers, you should see an answer to that exact question. So I'll direct you to that one. There was a few of us had a bit of a discussion about that topic, and you'll get a few different kind of opinions on how we think about that. So feel free to go and check that out. Matt, how do you structure your portfolio at this time between cash, number of holdings, and waiting? Yeah. So again, it sort of just depends on the opportunity set. So when you say at this time, I'm sort of interpreting that to mean like because of all the things that are going on macro-wise, or whole sort of stock market valuation's been quite high and that sort of thing. I really don't adjust the portfolio a huge amount for that kind of stuff. Again, it's very bottom-up kind of a very bottom-up sort of approach to investing, where I'm looking at the opportunity sets available. If something looks attractive, I'll buy it. If I can't find anything attractive, I'm obviously still earning income in my day job, so the cash kind of just builds up as a percentage of the portfolio. And that's basically just how I manage it. So As it stands right now, if you exclude the money that I've got set aside to buy my first home, cash is actually kind of low at the moment. I've found a couple of things that have been interesting in the last 6 months or so, and that's kind of where I'm sitting. And in terms of the number of holdings, again, it's kind of just to do with the opportunity set. If I can find a bunch of stuff that I understand and I think is undervalued, I'll tend to be a little more diversified. If I can't find that much, I'll tend to be maybe a little bit more concentrated. Probably an optimum number of holdings where I'd really like to be is maybe somewhere around 8, roughly, possibly like 6 to 10 is a bit of a range. I think you can really struggle to genuinely keep up with understanding the nuances of a whole bunch of individual businesses once you get past that point. So that's kind of how I think about that. Okay, next question is from Patrick Chapman. With likely inflation, are you hedging against it by purchasing precious metals or mining companies? Short answer is no. I've done a couple of videos on inflation, and I sort of take the Warren Buffett stance of buying high quality businesses with pricing power, and that's again actually something we talked about on the punch card investing stream a couple of weeks ago. We used See's Candy as an example to talk through that. If you're in a business that can crank up their price because they have a product which is kind of entrenched in people's lives and so on, that's a nice counter to inflation, and I don't think you need to really get into like gold companies or do anything particularly special there. Second question from Patrick was, have you bought Alibaba? I don't typically share a lot of my personal portfolio kind of on the channel, with the odd exception. We've done the Heritage Growth Properties live streams and all that sort of thing, but I will say Alibaba is very interesting to me, and I'm trying to understand it a little bit more. I've got some books in the post on Jack Ma and Alibaba and so on, and I've been doing as much reading as I can on that particular business because it's not the simplest one in the world, but some initial valuations and stuff look pretty attractive, so I'm trying to get my head around it kind of as best I can. So thank you for your question. Next one is from Adam. What are your investment goals? I've been following you for a while and very impressed. Thank you. Is there anything you're saving for, like an early retirement? Do you have bigger goals, like trying to become the next Warren Buffett? I don't think there will be another Warren Buffett, frankly. Warren Buffett is very uniquely set up to be a phenomenally rational investor, and he also started off when markets were pretty objectively a lot less efficient than they are today. So I really don't see there being another Warren Buffett, and it's certainly not going to be me if there is one. But in terms of investment goals, I've never really had the goal of getting like ridiculously rich or anything like that. The sole reason that I invest at all really is to get to a point of freedom at some point. So most people are stuck in the rat race of trading their time for money in their day jobs, and I really enjoy my job, and I also enjoy putting out the content here on YouTube as well, and both of those things bring me income, which is great. But I want to be able to have the choices, the choice to stop doing those things if I want to. Maybe not necessarily YouTube, but I want to have the option to do less of the day-to-day grind to pay bills and so on if I want to. So that's kind of my goals for investing, and I guess the way that would manifest itself would just be consistent kind of compounded returns. That's how I would get to that point. So appreciate your question, Adam. Next question is from Jack. Any more upcoming interviews with top value investors? Nothing on the cards at the moment, but if you guys have got anyone in mind that you think I should reach out to and you'd be interested in seeing on the channel, I can do my best. I don't know if I have the most power in the world to get a bunch of really famous value investors on, but you can only try. So if you got anyone in mind, certainly let me know. So next question is from Brian McDaniel. How are you feeling about A2 Milk and Redbubble stocks? Enjoyed your interview with Tobias. Thank you very much. In terms of A2, I've made several videos on the topic, and my thoughts on the matter really haven't changed since a couple of weeks ago when I put the last video out. I'll default to that video. Really nothing significant for me has changed with how I view A2. And in terms of Redbubble, I've never really done a deep dive on it, but I know Investing with Frank has done a few videos on Redbubble. So again, I'll direct you to people who know a bunch more about that topic than I do. So feel free to go and check out Investing with Frank on YouTube, and you should see some good Redbubble stock analysis over there. So thank you for your question. Next question is from Bob Ross. Can you make a video of your monthly or yearly income slash expenses as a series like the 13F series you have? Yeah, I actually read this question yesterday and was kind of having a bit of a think about this and whether it would be a good topic for the channel. And I think it would probably be interesting to some people potentially. Bob, of course, you sound like someone that would be quite interested in that. But at the same time, I feel as though everyone's situation is slightly different. So, I don't own a house or have kids. Some people do own a house and have several kids, and that kind of changes the income potentially and certainly the expenses equations for people. So I can put myself out there as an example, and I'm a fairly open book. So if there is some interest in some of that stuff, I'm happy to share it. But I think the underlying principles behind what I'm doing are going to be far more powerful in terms of helping you to progress forward. So the things like, the real basic stuff like paying yourself first, setting up goals, investing consistently, focusing on the large expenses in your life and how can you get those down, finding a scalable source of side income if you have the time available to do that. I think understanding those principles is probably going to be much more beneficial than me putting myself out there as an example and showing you how much I spent at McDonald's or whatever last month. But if you guys want to see that, happy to share if there is interest for me to do that. So thank you for your question. Next one is Vagabond. Do I need to get a bust off Charlie Munger to be successful? No, but I'm sure it certainly helps. So if you're not familiar, that's something that Guy Spear and Monish Pabrai have both done. So I don't think it can hurt, but I don't think it's a requirement to be successful. So thanks for that question. Speaking of investing with Frank, here he is with a question. What is your target return on an investment? Assuming you invest for the next 50 years, what type of compound annual growth rate would you be happy with? And what would be a disappointing return? So I've actually, I think, discussed this a couple of times with Frank offline. But I don't know if I've ever stated it on a video. I'm not too sure. But the way that I've thought about this over time has changed a little bit. So I still probably think about it a lot of times like sort of an old school Monish Pabrai type approach where his initial framework was buy a dollar for 50 cents, and then basically your return is dictated by how long it takes that 50 cents to go back up to $1. So if that happens in 3 years with a particular stock, that's a double in 3 years, which is a 26% rate of return. If it happens in 5 years, it's 15%. If it happens in 1 year, that's 100% on that particular stock. And averaged out with some mistakes built in, you should come out the other side with a pretty good track record. So that's kind of how I've thought about it. I don't have a really particular rate of return in mind. I think my savings rate is such that even if I can get 8 or 10% a year, I will probably end up at some point with more money than I know what to do with. That's kind of where I hope to be, and anything over and above that 8 or 10% is kind of, cream on top, and you can do some cool things with helping other people and that sort of stuff when you get to that point. So that's kind of the way that I think about it. I guess if I had to put a number on a target return, somewhere in the 10 to 15% range, I would be over the moon if I could do that for an extended period of time. If you can crank out 15% plus for 20 or 30 or 50 years, like you've said here, that's when you're an all-time great almost at that point. That's sort of, approaching Warren Buffett, Charlie Munger, Seth Klarman, Monish Pabrai type returns. So if I could do that, that would be phenomenal. A disappointing return would be 5 or 6% a year or something, lagging what the S&P 500 has done traditionally would be something that would be quite disappointing. But yeah, I don't have a specific rate of return in mind, just because that's not how I typically kind of think about making investments into particular companies. But if I ever do make the transition fully towards a more modern Buffett style where you're buying these long-term compounders, I probably would think about it with a bit more of a hurdle rate in mind potentially. I don't know if he's ever really actually come out and said it publicly, but I know it's been rumored for a long time that Buffett and Berkshire Hathaway's sort of hurdle rate for making a particular investment is about 10% a year. So if they're confident that they can get at least 10% with, a bit of margin of safety built in, they will tend to put capital to work. And oftentimes, since they're building in these margins of safety and being conservative, they end up with a lot more than 10% and so on. So if I ever transition to that more compounder type approach, maybe that's how I'll start to think about it. But like I say, really don't have a specific rate of return in mind as for now. Okay, next question here is from Henry. Is it time to stop watching endless investment YouTubers, apart from Investing with Tom, of course, thank you, and actually start doing your own stock market research, or be a bit more selective with what we watch? I'm guilty of getting caught up in these videos at the expense of actually getting on with my research. Cheers. I think that's an exceptionally good point. I have fallen into this trap as well, where I spend time watching watching other YouTubers rather than spending time or dedicating more time to investment research. One of the other things I tend to put in that category a bit as well is even like reading about investing. I find super interesting, adding things to the bookshelf and so on is really enjoyable to me. But at a certain point, you need to start reading for investing as opposed to just, about investing as well. So, if you're gonna sacrifice some other YouTubers and keep me in there, thank you. I'm very grateful for that. But I think that actually would be quite beneficial to basically just turn over more stones, turn over more rocks, look at a larger range of investments over time, and then of course the more things you're looking at, the more likely it is you're going to find interesting opportunities. So I think that makes a whole lot of sense. So next question is from David. How did you go about approaching the $50,000 FIF threshold? Concentrate on NZX/ASX to stay below 50k, carry on investing in as normal, or wait for an extremely attractive opportunity to deploy sufficient capital to justify the new tax? So this is a rule for anyone that's not from New Zealand or that doesn't have $50,000 or more invested outside of New Zealand and Australia. If you are a Kiwi, that is a tax that will hit you if you have a cost basis larger than $50,000 outside of New Zealand and Australia. So I've actually been in contact with a few different people who are really experts on this topic. So I guess I'd be interested to hear the appetite to see maybe like a video or a podcast or something on that topic. If that's something that's of interest, let me know. But to answer your question, once you go over that $50,000 threshold cost basis, New Zealand and Australian investments become far more attractive than US investments. That's just how it works out mathematically. And like you say, in order to justify paying that extra tax, you need to get a higher rate of return from investing in some of those stocks. That is how I'm starting to think about it. And it's a pretty painful tax when you're potentially paying, tax on unrealized gains, which is not a fun thing at all. So I'm no expert on the topic, but if you're interested in getting an expert onto the channel and hearing more about that, then certainly let me know down in the comments below. All right, next question is from Shane Logan. Do you prefer Phil Fisher or Ben Graham? Ben Graham all day long. I do have a Phil Fisher book behind me there, Common Stocks and Uncommon Profits, but definitely a big Ben Graham fan. So that's the answer to that one. Next question is from Douglas. Apologies if I'm butchering that one. In one of your recent videos, you mentioned you will look into Baba to see if it is a worthy buy at this point in time. Just curious what your further research revealed as risks and potential advantages. So I think in the initial video that I did on Alibaba and motorized investment and so on, I think I did a reasonable job of trying to sort of break down the categories of Alibaba's business. I really don't have any significant updates other than to say I'm still trying to, work through understanding those things as best I can. Also trying to understand the accounting and how that works with all the subsidiaries and so on as well. So still working away at that. Maybe I'll do an update video once I feel like I've got my head around that one a little bit more. So thank you for your question. So Klitschwaber asks, would you dollar cost average into a stock you really like, or is that only for index funds? If I had more cash coming in the door and it was still at a margin of safety price, I would probably keep buying it. But at a certain point, with my particular strategy, there's prices where an investment doesn't make sense and there's prices where an investment does make sense. So if it's in the doesn't make sense kind of price range, that I probably wouldn't dollar cost average. But if I was an index or ETF investor, then all day long I'd just dollar cost average till the cows come home and kind of not stop. But But with individual stocks, it can be a bit different. So, at times there's a lot of things that are attractive to do, and at other times there's things that don't make a lot of sense to do, in which case the cash again just accumulates until something interesting comes up. Okay, next question is from Hitanshu. Apologies if I'm butchering your name. How long do you think the metal rally is going to sustain? Yeah, not sure. Commodity stocks have been on this massive run lately, and I've had a bit of exposure to that through my GraphTech investment. Again, I talked about that on Punchcard Investing a few weeks back. But yeah, I would just be purely speculating if I was to attempt to answer that question. The big question really is, it's rumored that, or it's kind of speculated that this big boom in commodity prices has really come from lots of shortages, from kind of starting to reopen the supply chain. So we really will just have to wait and see whether prices normalize as supply comes back online and so on. Once things are fully reopened. But again, I don't know the answer to that, and we will kind of just have to wait and see how that one plays out. So thank you for your question there. And final question is from Frank Mooney. If offered a margin facility at an attractive interest rate, say below 1.5%, would you avail, or I guess basically, would you add margin to your portfolio is basically, I think, what that question's getting at. So the answer to that basically is no. I guess the interest rate, of course, it is important anytime you're using debt to invest in some way. But the thing that keeps me away from margin, investing on margin, really, is not particularly the interest rate. It's really the fact that you can get margin calls and so on. So, I'm actually surprisingly comfortable. I kind of found that out about myself, with some of my stocks being down as much as 50%. If I'm confident that the investment case still holds true, I'm perfectly, fine with seeing that happen, and I see that as an opportunity to buy more if it's a really good business. When you're investing on margin, and that potentially happens, and it will happen because stock markets are quite a volatile beast, you can get margin calls and be forced to sell at really low prices where you would rather be buying, and that's just not a situation I want to get myself into. So if I had some other form of debt that was not callable, you couldn't get margin calls, Warren Buffett's float at Berkshire Hathaway is actually a pretty good example of that. That would be far more attractive, but a typical kind of margin loan is not something that's of interest to me at all. Okay, and that is all the questions. So thank you to everyone who asked one. I do hope you enjoyed that video. Again, if you want to get a question answered in future Q&A videos, keep an eye out for the community posts. If you're interested in the Hatch offer, you'll need to go to the link on the screen here and take advantage of that deal. But that's it from me for this one, and I will see you in the next video. Cheers.